Listen here. Section 112. We learned section 112 where I told you that tax on general capital gain is how much? 20%. Tax on general capital gain is 20% up to 22/7/2024. But that is with indexation. From 23/7/2024 onwards, tax on capital gain is 12.5% without indexation. Okay. I also told you that resident, individual and HUF have the benefit to adjust the income which is taxable under section 112 against the unexhausted basic exemption limit. Then I also told you about this provision. Please read it once again. If an immovable property is transferred on or after 23/7, then the tax as per 112 shall be 12.5% without indexation or 20% with indexation, whichever is lower. This is applicable only if the following conditions are satisfied. Number 1, assessee should be resident individual or HUF. So, to a partnership firm, AOP, BOI or company, this indexation benefit is not given. Only for resident individual or HUF it is given. Then, immovable property should be a long-term capital asset acquired on or before 23/7/2024. So, property should be purchased on or before 23/7/2024. Then the transfer shall take place on or after 23/7/2024. Then only you can take this with indexation, without indexation, compare both, whichever is lower can be taken as tax. Okay. Now, let's come to section 50CA. Section 50CA, full value of consideration in case of unquoted shares. Unquoted shares na unlisted shares. You can just remember this as unlisted shares. Unquoted means unlisted. In case of unlisted shares, if the sale consideration is less than fair market value, then full value of consideration shall be fair market value. So unlisted shares should be traded at minimum. Full value of consideration should be minimum fair market value. Full value of consideration should be minimum fair market value. Then section 50D. If sale consideration cannot be determined, then the fair market value of such asset as on the date of transfer shall be full value of consideration. If sale consideration cannot be determined, fair market value of such asset on the date of transfer shall be full value of consideration. For example, I sold my house, okay, and in return I am telling you that you give me food for the rest of my life. I sold my house to you and I am telling you for the rest of my life you give me food. So the sale consideration, can I determine the value? No. In such case, what is the fair market value of the house that I am giving you? That will become full value of consideration. Next, section 111A. Section 111A, short term capital gain on certain assets. So generally short term capital gain is taxed at normal tax rates, that is slab rate. Generally, short-term capital gain is taxed at slab rate, but only in certain cases there is a special rate. Generally, slab rate, in certain cases, special rate. Now see here, applies to short-term capital gain in case of equity shares of company, unit of equity oriented fund, unit of business trust on whom STT is paid on transfer. Equity shares of company, unit of equity oriented fund, unit of business trust on whom STT is paid on transfer. STT is paid on transfer na enna, it means that these are listed. Okay, because generally only if it is listed, STT will be paid on transfer. If STT is paid on transfer on these three, then if this is transferred, then short term capital gain will be taxed at 111A. Short term capital gain will be taxed at 111A. What is 111A? 111A is 15% if the transfer is before 23/7, 20% if it is on or after 23/7. So earlier it was 15%, now it has become 20%. So short term capital gain under 111A, if you are getting in the question, if the transfer date is before 23/7, take 15% as tax, on or after 23/7, take 20% as the tax. All the other short term capital gain will be taxed at normal tax rate. So to whom does this 111A apply? Equity shares, unit of equity oriented fund, unit of business trust on which STT has been paid on transfer. Then section 112A, long-term capital gain on certain assets. See, similarly, there is section 112A also, similar to 111A. Here also, it applies to long-term capital gain in case of equity shares of company, units of business trust, unit of equity oriented fund on which STT is paid on transfer. But in 112A, one extra condition for equity share is that STT should have been paid on purchase also. So when an equity share is sold, STT is paid on transfer. STT should have been paid on purchase also. In such case, transfer of such equity share is taxable under section 112A. 112A. This STT condition is there, no? In both 111A and 112A, it is not applicable to IFSC, International Financial Service Center. It is not applicable to IFSC because in IFSC there is no security transaction tax, but there is a stock exchange. Now, what is the tax rate in 111A? 112A, it is 10% on income in excess of 1,25,000. So from 0 to 1,25,000, the tax is 0. Above 1,25,000, the tax is 10% before 23(7). After 23(7), from 0 to 1,25,000, it is 0. After 23(7), it is 12.5%. So earlier it was 10, now it becomes 12.5%. So 112A also new tax rate is 12.5. 112 also new tax rate is 12.5. But in 112A they have increased the tax from 10 to 12.5. But 112 they have decreased the tax from 20 to 12.5. Okay, wow. So what is the minimum amount till which there is no tax? 1,25,000. Tax only will be over and above 1,25,000. So for example, 5 lakhs is the total capital gain. In such case, 1,25,000 no tax. Balance amount 3,75,000 multiplied by 10% or 12.5% as the case may be. Sir, there is capital gain which is before 23(7) also, capital gain which is after 23(7) also. Both are given together. In this case, 1,25,000 from where we should deduct? We should deduct from the before value or should we deduct from the after value? See, there is no clarity in law regarding this. So, if there is no clarity in law, no, generally in intermediate they will not give this question itself in examination. First thing, either they will give before or they will give after. They will not give both. If at all they are giving both, solve in any way you want, everything will be correct. Okay. So, listen. Let's say 2 lakh rupees is before 23(7), then 3 lakh rupees after 23(7). So total is how much? 5 lakh rupees. Now from this 1,25,000 you have to reduce. 375 is taxable. Correct. Now this 375, how much you should take for before, how much you should take for after? If you ask me, I will obviously take the beneficial one. So for before I will take entire 2 lakhs and multiply it by 10%. Then balance amount is there, no? 1,75,000 into 12.5%. If I was writing the exam, I will do like this and finish it off. But in exam, this question will not come. Don't worry. But உங்களுக்கு அந்த confusion வரலாம். Then நீங்க stress ஆயிருவீங்க. அதுக்கு இப்போவே சொல்லிட்டேன். Okay. Then if an income is taxable under 112A, there is no indexation. There is no indexation. So before 23(7) also no indexation. After 23(7), however, no indexation. Sir, what about cost of acquisition? Cost of acquisition is generally purchase price. However, before 1/2/2018, this 112A was not existing. The capital gain used to be exempt. There was no capital gain at all. But all of a sudden, Sri Arun Jaitley came and then he told that I will start taxing the long-term capital gain. Fine. So then onwards, but the people who had already purchased before this budget, that is 1 February 2018, the people who had already purchased the shares and were keeping it as long-term, then they were cheated. Correct? Because they purchased just by thinking that it is going to be exempt. By thinking that it is going to be exempt, but now all of a sudden they are telling that it is taxable. So the government introduced grandfathering clause. According to this grandfathering clause, if you have any gains till 31/1/2018, there is no tax on such gains. That's the concept. if there is any capital gain which you have earned till 31/1/2018, then there is no tax on such gains. Okay, hence you take the value on 31/1/2018. 31/1 தான கொடுத்திருக்காங்க. ஆமா, 31/1/2018 take the value. If it is higher than your cost, no, then take this value as the new cost. And over and above this cost only you start doing the calculation. Fine, that is only the concept. Concept is very, very simple. Now, so how to determine cost of acquisition? Fair market value as on 31/1/2018 or sale value, whichever is lower. But because of this, loss should not come. So fair market value as on 31/1/2018 or full value of consideration, whichever is lower or actual cost, whichever is higher, will become the cost of acquisition. Cost of acquisition. Because earlier it was exempt income. Exempt income enkunna loss also will be exempt. So loss also exempt means what? You cannot set off or carry forward that loss. You have to ignore that loss. For example, agricultural income is exempt. Loss from agriculture also you cannot set off against business income. Okay, so whatever income is exempt, loss also is exempt. That is only concept. So here also, because of this grandfathering, you should not get a loss. It means extra benefit is given to you. Fine. That is why for grandfathering, what you should do, fair market value as on 31/1 or full value of consideration, that is sale value, whichever is lower or actual cost, whichever is higher, should be taken. Okay. Then if the asset is acquired on or after 1/2/2018, then take the actual cost itself as cost of acquisition. Then it is very, very simple. If it is purchased on or after 1/2/2018, just take the purchase price. Purchase price is only cost. Before 1/2/2018 only you have to worry. That if it is before 1/2/2018, then take fair market value, compare it with sale price, whichever is lower, then this lower amount or actual cost, whichever is higher, will become your cost of acquisition. Okay. Then fair market value as on 31/1/2018, if it is listed, it is the highest price quoted on 31/1/2018. In the stock market on 31/1/2018, what was the highest price? That you have to take. If no trading was done, then highest price on the immediately preceding trading date. If it is unlisted now, then if it is units, take the NAV of the units. In case of unlisted security, take the NAV of the units. And if shares are unlisted now, then you do indexation. But this is not that important. This indexation, இது வரைக்கும் கேட்டதில்லை, கேட்கறதுக்கும் I don't think வாய்ப்பு இருக்கு. Okay. So we have covered the tax rate also. Now let us cover exemptions quickly. Now listen, first exemption 54 alone, I am going to take it properly. All the other exemption first புரிஞ்சிருச்சுனா மீதி எல்லாமே easy டக் டக்னு நான் எடுத்துருவேன். Everything you will be able to understand. So first one is section number 54, capital gain on sale of residential property and used for residential purpose. Capital gain on sale of residential property. Now it is applicable to whom? Only individual and HUF. Only individual and HUF. The asset transferred should be a long-term capital asset. What should be the asset transferred? Residential house being land or building or building and land appurtenant thereto. So residential house should be transferred. This residential house should be a long-term capital asset, and for that you should buy or construct another residential house. So when will section 54 be applicable? You are having a residential house, you are an individual HUF, you are having a residential house, that is a long-term capital asset. You are selling this residential house, and with that money you are buying another residential house. Okay, ஒரு வீடை வித்துட்டு இன்னொரு வீடு வாங்குறது. Fine. New asset should be one residential house property in India. One residential house property in India. So what should be the new asset? That capital gain is there, no? You should invest to get one more house property in India. Now listen, if the capital gain is up to 2 crores, the Income Tax Act is given once in a lifetime benefit. This is a once in a lifetime benefit. Once in a lifetime benefit, that up to, if the capital gain is up to 2 crores, then up to 2 residential house property also can be purchased. If it is more than 1 crore, this benefit is not at all available. If the capital gain is within 2 crores, sorry, more than within 2 crores, ரெண்டு வீடு வாங்கிக்கலாம். பட் ஒரு தடவை தான் இந்த பெனிஃபிட் யூஸ் பண்ண முடியும். புரியுதா? Now what did I say? Listen here. There is one house. Okay. I bought this house, let's say, for 5 crores. I bought this house for 5 crores. Now I am selling this house, sold for 6.5 crores. 6.5 crores. Let us assume that this is after 23/7/2024. So indexation la kadayadu. 6.5 crores. So what is the capital gain? 1.5 crores. With this 1.5 crore capital gain amount, 1.5 crore capital gain amount, I can buy two houses. Two houses. Let's say one house is 70 lakhs, another house is 80 lakhs. Is it allowed? Answer is yes. Buying two houses is also allowed, but allowed only one time the life of the assessee. Okay, va? Generally you should buy how much? Only one house. You are allowed to buy only one house. But can you buy two houses? Answer is, if your capital gain is within 2 crores, you can buy two houses, but that too you can do only once in a lifetime. Okay. Generally you can buy only one house, but if your capital gain is within 2 crores, you can buy two houses. These two houses also you can buy only once in a lifetime. Okay. Now, okay. So time limit to purchase or construct. You can even construct the new house. Buy in avashyam kadayadu, you can also construct the new house. So if you are purchasing the new house, it should be within 1 year before or 2 years after the date of transfer. Take the date of transfer 1 year before, 2 years after. Or if it is construction, then it should be completed within 3 years after the date of transfer. So -1 plus 2 plus 3. -1. So -1 plus 2 is for what? Acquisition. Plus 3 is for construction. So -1 plus 2. 1 year before the date of transfer, 1 year after the date of transfer. Sir, why 1 year before? Because if I sell the house, afterwards if I start searching for new house means it is difficult. So generally people purchase new house first and then only they sell their old house. So -1 plus 2 plus 3. If you are purchasing 1 year before or 2 years after the date of transfer, if you are constructing, construction should be complete within 3 years after the date of transfer. Okay. Then deposit scheme. Sir, how will the government know that within 3 years you are going to invest in the new house or not? In previous year 24-25, let's say you transferred a house property. Previous year 24-25, you transferred a house property. Now you are telling the government that now I cannot buy within 3 years, within 2 years or 3 years as the case may be, I will buy or construct the house. How will the government know? The government will know if you are depositing the entire capital gain amount in a deposit scheme. This deposit scheme is called CGAS, capital gain account scheme. CGAS, capital gain account scheme. So it is nothing but a special bank account. Okay, wow. In this bank account you should deposit the entire capital gain, and then you should tell the government while filing the return that I have deposited this money. This money I am going to use it only for buying or constructing the house within 2 or 3 years as the case may be. Then the capital gain will be allowed, and after 2 years or sorry within this 2 years or 3 years you should spend the money only for buying the new house or constructing the new house. If you are not able to buy or construct, what will happen? The amount that you deposited to the extent that you did not use will become your income in capital gain. Next, amount of exemption. Sir, what is the exemption? Exemption is capital gain amount or cost of new asset whichever is lower, maximum 10 crores. Capital gain amount or cost of the new house whichever is lower, or houses, if you are purchasing two houses, whichever is lower, maximum 10 crores. So maximum what is the capital gain exemption that you can claim? 10 crores. 10 crores ke mela pochna limited to 10 crores. Exemption should be limited to 10 crores. Next, transfer of new asset. Now listen, this new house that you are going to buy or construct, no, this also you have to keep it at least for 3 years. You have to keep it at least for 3 years. New house I cannot sell it within 3 years. If you sell within 3 years, what will happen? If new house is transferred within 3 years from the date of purchase or construction, then cost of acquisition of new asset will be reduced by the exempt capital gain. Okay, so reduce the exempt capital gain from the cost of new asset. So the cost will become very, very low. So when the new asset you are selling, automatically capital gain will increase by that much amount which you had already claimed. So புது வீடு வந்து 3 வருஷம் வரைக்கும் விற்க கூடாது. வித்தாச்சுனா என்ன பண்ணணும்? Then capital gain exemption claim பண்ணீங்களே அது வந்து காஸ்ட்ல ரெடியூஸ் பண்ணிருங்க. புது அசெட்டோட புது வீடோட காஸ்ட்ல ரெடியூஸ் பண்ணிருங்க. Okay, so one more time I am taking section 54, capital gain on sale of residential property used to purchase another residential property. So individual and HUF, only for them it is applicable. Asset should be a long term capital asset being a residential house. You should transfer it to get or construct another residential house, and the time limit is -1 + 2 + 3. Purchase within 1 year before or 2 years after the date of transfer. Construction completion within 3 years after the date of transfer. Now, new asset, how many houses can you purchase or construct? If your capital gain is within 2 crores, you can purchase or construct 2 houses only once in a lifetime. If it is above 2 crores, then only 1 house. Okay, then time limit is what? This I already told you. Then deposit scheme. If you are not able to purchase within the due date or construct within the due date to file return of income, then before the due date to file return of income, transfer the money into capital gain account scheme and show that you have done it in the return of income. Okay, and then later on use that amount in the capital gain account scheme only for purchase or construction of the new house within time limit. If you are not using the capital gain account scheme money properly, then the misutilized amount will be added to capital gain. If you are 2 year or 3 year time period is lapsed, still you were not able to use, na, it will be added to capital gain. Then this new house is there, no, new house also you have to keep it for 3 years. If you are selling it within 3 years, then reduce the cost of the new house by the exempt capital gain. Understood? Now all the others I will quickly brush up. Section 54B, capital gain on sale of urban agricultural land used for buying another agricultural land. So applicable to individual or HUF. It can be long term also, it can be short term also. Agricultural land used by individual or his parents for agricultural purpose at least for 2 years. And new asset is also agricultural land, it can be rural or urban. So I was having an agricultural land and I was doing agriculture on it for 2 years at least. Now I want to sell this agricultural land and I want to buy another agricultural land. Is it allowed? Answer is yes. While selling, it is applicable only if you are selling urban agricultural land. Rural ஏன் applicable கிடையாது? ஏன்னா ரூரல்ல கேபிட்டல் கெயினே கிடையாது. ஸோ எதுக்கு எக்ஸம்ஷன்? ஓகேவா, அர்பன் அக்ரிகல்ச்சர் லேண்டுக்கு தான் எக்ஸம்ஷன் இருக்கு, ரூரலுக்கு எக்ஸம்ஷன் கிடையாது ஏன்னா கேபிட்டல் கெயினே கிடையாது. ஸோ யூ ஆர் செல்லிங் அர்பன் அக்ரிகல்ச்சர் லேண்ட் and you can buy what? Rural also, urban also, both can be purchased. For this, what is the time limit? Within 2 years after the date of transfer. Here also this deposit scheme is applicable. Here also what will be the capital gain exemption? Capital gain or cost of new agricultural land, whichever is lower. Then this also, new agricultural land you should not deposit within 3 years. If you are transfer within 3 years. If you are transferring within 3 years, reduce the cost by the exempt capital gain. Next, compulsory acquisition of industrial land and building. So it is applicable to all persons. It can be company also, HUF, AOP, BOI, anyone, and it can be short term also, long term also, does not matter. So if the government is coming and compulsorily acquiring your industrial land and building, then you can purchase another industrial land and building to get exemption from capital gain. Exemption from capital gain. What is the time period to get new land and building for industrial purpose? Within 3 years from the date of receipt of compensation. Here you should be careful. It is date of receipt of compensation. So compulsory acquisition பண்ணதிலிருந்து 3 years கிடையாது, compensation கிடைச்சதிலிருந்து 3 years குள்ளார you have to purchase or construct new land or new industrial land or building undertaking. Okay, balance all the provisions are same. Here also it is applicable, deposit scheme is applicable, and here also the exemption is capital gain or cost of new asset or deposit, whichever is lower. Here also you should have at least for 3 years. If you are transferring within 3 years, then reduce the cost by the exempt capital gain. Now section 54 EC. section 54 EC. Exam if you ask me what is important na, 54 is important, 54 EC is important, 54F is important. 54, 54 EC and 54F frequently asked. Okay, so 54 EC, investment bond. Any person, long term capital asset, being land or building or both. Okay, wow. It is applicable to every person, and the asset should be long term capital asset, the asset should be land or building or both. So if land or building or both, I want to transfer, and I don't want to take 54 exemption and all, I don't want to buy new residential house property, I just want to keep the money. In such case, what you can do, you have to invest that money into the bonds of National Highway Authority of India, Rural Electrification Corporation Limited, Power Finance Corporation Limited, Indian Railway Finance Corporation Limited. So NHAI, RECL, PFCL, RFCL. NHAI, RECL, PFCL and RFCL. Maximum exemption is 50 lakhs. Maximum exemption is 50 lakhs. So if capital gain is more than 50 lakhs, only up to 50 lakhs you can invest. More than 50 lakhs if you are investing, no benefit. Maximum exemption is how much? Only 50 lakhs. Okay. And these bonds are there, no? Here there will be a lock-in period of 5 years. You cannot take the money out for 5 years. And till when you should invest? You should invest within 6 months from the date of transfer. Investment should be done within 6 months from the date of transfer. Sir, 6 months from the date of transfer na sonninga. So is deposit scheme applicable? Answer is no. The time period itself is so short. So no deposit scheme applicable. You have to purchase the bonds before filing return of income or within 6 months from the date of transfer. Okay, wow. Then, so time limit is what? 6 months from the date of transfer, and there is a lock-in period. I told you, no, 5 years lock-in period. So you cannot take your money out for 5 years. Sir, I can't take my money out, but I want funds. So can I take a loan against these bonds? Answer is no. You also cannot take any loan against these bonds. If you take a loan against the bonds, then also it will be added to capital gain. Okay, wow. Deposit scheme not applicable. Next, amount of exemption is equal to capital gain or cost of new asset, whichever is lower. Then transfer of new asset. Transfer of new asset. If new asset is transferred or converted into money within 5 years from the date of acquisition, exempt long-term capital gain will be taxable in the year of such transfer or conversion. So whatever it was exempt earlier, now it will become taxable. Fine. Now let's see section 54F. 54F வந்து எதுக்குனா 54 was வீடு வித்துட்டு வீடு வாங்குறது, selling house and getting another house. But 54F is selling any other long-term capital asset other than house and getting a new house. Okay. So 54F is applicable for individual or HUF for a long-term capital asset being any capital asset not being residential house. So other than residential house. And then he is buying one residential house in India. Buying one residential house in India, buying or constructing, whatever. So here also the time limit is -1 plus 2 plus 3. -1 plus 2 plus 3. Deposit scheme applicable? Yes, applicable. Maximum exemption is how much? 10 crores. Maximum exemption 10 crores. But here there is one catch. In all the sections we saw that you have to invest the capital gain amount. Capital gain amount. But in this section alone, you should not invest capital gain. You should invest the full value of consideration. You should invest the entire full value of net consideration. Reduce the transfer expense. Net consideration is there, no? That should be fully invested. Sir, what if I am not investing full value? I am investing only 50% value, 50% of net consideration. In such case, only 50% of capital gain will be exempt. Sir, I am investing only 30%, then only 30% of capital gain will be exempt. So here you have to write proportionate. Cost of new asset multiplied by capital gain divided by net consideration. Cost of the new house multiplied by capital gain divided by net consideration. So proportionate amount. Capital gain by net consideration. This is the proportion. Multiplied by cost of new house. Maximum exemption is 10 crores. Okay. So you should invest what? You should invest net consideration. Net consideration. So if you invest 60% of net consideration, then 60% of capital gain will be exempt. 70% of net consideration, 70% of capital gain will be exempt. Okay, wow. Maximum exemption is how much? 10 crores. This 10 crores limit is in which two section? 54 and 54F. In these two sections, for that house, for buying new house, maximum exemption is 10 crores. And 54EC, what is the maximum limit? 50 lakhs. For that bonds, 50 lakhs is the maximum limit. And next one, Ningle Pathukonga, not so important. 54EE. Okay, now let us see some special point. Deposit scheme. Amount shall be deposited in the capital gain account scheme within the due date of filing return of income. Amount so deposited shall be used within the specified time. If not used, it will be taxable as capital gain in the year in which time expires. Okay, next 54EC and 54EE. If loan or advance is taken on the securities before time limit, then also capital gain will be taxable. Okay, 54F, there are some additional condition. What is the additional condition? Assessee shall not own more than one residential house. Now listen, when 54F, what is 54F? Any other long-term capital asset other than residential house and purchasing residential house, purchasing or constructing. In such case, when this transaction is happening, before you can have maximum one house only. Adhik mala endishna, this section itself not applicable. Okay, then assessee shall not purchase any residential house within the time period other than the new asset. If this is not satisfied, exempt capital gain will be taxable in the year of purchase or construction. Then purchase பண்ணும்போதும் ஒரு வீடு தான் வாங்கணும் இல்ல ஒரு வீடு தான் கன்ஸ்ட்ரக்ட் பண்ணணும். More than one house, this entire section not applicable. Okay, so earlier you can have maximum one house and then maximum one new house. Correct? Maximum one new house, total two houses. If before you were having more than one house, section not applicable. If within the time period you are buying more than one house, this section not applicable. Then in case of compulsory acquisition, all the time limit will start from the date of getting compensation. Okay, wow. That time limit alla irukla -1 +2 +3, all this will start from the date of receiving compensation from the government. Now let us see section 50, capital gain on depreciable asset. Capital gain on depreciable asset. First straight line method paathukalam. WDV we have already discussed. One more time I will discuss. So straight line method la enna agum? Listen here. In case of straight line method, when does straight line method apply? Only for generation of power, generation and distribution of power. They have the option to choose straight line method or WDV method. If they are choosing straight line method, then if the capital asset is sold, what will happen? Let us see. If sale price is greater than WDV, then selling price minus WDV is called terminal depreciation. It is allowed as a deduction in PGBP. If sale price is more than WDV but less than cost price, then selling price minus WDV is called balancing charge. It is treated as an income in PGBP. If selling price is more than cost price itself, then the amount up to cost price will be called capital gain, and below the cost price up to WDV will be called balancing charge. Okay, ஒரு question பார்க்கலாம், you will be even more clear. So I want you to write down this question first. Be very quick. 5:30 kullare at least let us finish capital gain. So Arul has asked the doubt, sir, exemption before 23/7 is 1 lakh or 1.25 lakh? Answer is 1.25 lakh. For the entire year it is 1.25 lakhs. Done? Okay. Calculate the capital gain of machinery used by power generation unit on which depreciation is calculated on SLM method with the following information. Cost is equal to 60 lakhs, depreciation rate is 8.25%, 8.24%. It will be given in the question itself, depreciation rate. Period of holding 2 years. Selling price is case 1 36 lakhs, case 2 55 lakhs, case 3 62 lakhs. So now we will come here. WDV is equal to cost price minus depreciation for 2 years. 2 years is period of holding. So WDV is equal to cost price minus depreciation for 2 years. SLM method. Adana SLM board liya. I have given here no in question SLM method. WDV. So depreciation in year 1 is equal to 4,94,400. Year 2 is equal to 4,94,400. You want me to explain how this 494 came? No need, no? Yes. So the balance is how much? 50,11,200. 50,11,200. Now there are 3 cases. First case where the selling price is 36 lakhs. Second case where the selling price is 55 lakhs. And third case where the selling price is 62 lakhs. So first case paakalam. First case, selling price minus WDV is equal to 36 lakhs minus 50,11,200 is equal to 14,11,200. So this is a loss, but in SLM case, straight line method, there is no concept of loss. There is no concept of capital loss. There is no capital loss. Instead, what you will do, you take this as terminal depreciation. Terminal depreciation. And this is allowed as expense in PGBP. This is allowed as a expense in PGBP. Terminal depreciation. Then again we will do selling price minus WDV. Selling price minus WDV. So is equal to 55 lakhs minus 50,11,200 is equal to how much? 4,888,800. See, this is what? This is more than WDV. So this is like a profit. This is like a profit. So this is called balancing charge. This is income in PGBP. First one is deduction in PGBP. First one is deduction in PGBP. Second one is income in PGBP. Income is PGBP. Okay. Now let's come to 62 lakhs. So one point is that the balancing charge is there, no? That cannot cross the cost. Balancing charge cannot cross the cost. More than the cost in the excess amount will be capital gain. So listen here, 60 lakhs, okay, 60 lakh minus 50,11,200 is equal to 9,888,000 is equal to balancing charge. This is cost price minus WDV and selling price minus cost price is equal to 62 lakhs minus 60 lakhs, which is 2 lakhs. This is capital gain. Capital gain. Capital gain. Done? Be quick. So understood the concept? So if selling price is less than WDV, The amount below WDV, that is the loss, is terminal charge allowed as deduction in PGBP. The amount above WDV up to cost will be called balancing charge. Amount more than cost will be called capital gain. There is no concept of capital loss in case of straight line method. And here also depreciable asset. Listen here. In case of depreciable asset, number 1, capital gain or capital loss is always short term. It is what? Always short term. Then short term capital gain or short term capital loss can arise only in 2 cases. Only 2 cases. Number 1, selling price is greater than WDV of entire block. Hence there will only be gain, not a loss, since the selling price itself is greater than WDV of entire block. So block will be over and the excess amount will be short term capital gain. Block will be over, excess amount will be short term capital gain. Then when all the assets in block are transferred, in such case there can be gain also, there can be loss also. If the consideration is more than WDV, it will be gain. If consideration is less than WDV, there will be loss. So full value of consideration minus opening WDV plus addition will be the capital gain or capital loss. Though capital gain is always short term, if the asset was held for long term, assessee can take the benefit of section 54 series exemption. This has come after a court case law for long term capital gain. So, sir, my asset was a depreciable asset and there was short term capital gain, but this asset was held for long term. Can I invest in 54 EC and claim exemption on this short term gain? Answer is yes. Even though 54 EC is available only for long term gain, but here it is short term capital gain, still you can take the benefit because the asset was held for long term. Okay. Then last, let us discuss today's concept, section 50AA. Section 50AA. Pathada bayama irukku, pudu section. Okay va? Adile last year the section vandirukku, in the version amendment to vandirukku. So that is why let us give some importance to this section, although it is very easy. If you understand the concept, chappa. Now what is the concept? Let me tell you. So what were people doing? I will tell. Let's say I am investing in fixed deposit. I invested 1 crore rupees. On this I am getting 6%. 6% is how much? Or let's say 10 crore. 10 crore rupees. 6% is the interest. How much is the interest? 60 lakh rupees. On the 60 lakhs, let's say other incomes are occupying the slab up to 15 lakh rupees. Above 15 lakh rupees I have to pay 30%, no? So I am paying approximately 30% tax. 30% tax on this FD interest. Correct? Because interest is taxable under income from other sources. It is coming under slab rate. Because it is coming under slab rate, so I am having to pay a tax of 30% approximately because of the slab rate. So what did I think? I thought of a unique solution. What I did is I invested in debt mutual fund. Debt mutual fund. Then this debt mutual fund will invest in FD. Then they will earn 60 lakhs. And let's say I kept this debt mutual fund for more than 2 years. If I keep this as more than 2 years, then what will happen? It will become long term. It will become long term. If it becomes long term, let's say after that I sold. After it become long term, I sold it. So FD interest will be included in NAV, no, of the fund. Interest will be included in the NAV of the fund. After 2 years when I am selling this, then what will happen? I have to pay the tax only on 12.5%. So instead of 30, I am paying how much? Only 12.5, because indirectly I am investing in fixed deposit. So this was happening very commonly. People started discuss, instead of putting in debentures or instead of putting in deposits directly, they started to put into units. Okay va? And this units or debentures etc. avanga adla poda aarambichitaanga. Then when this debenture or units will become long term, then they will claim lesser taxation. So to avoid this only, the finance minister last year she brought 50AA. In 50AA, what she is telling, such type of instruments are there, no? This I will always treat as short term. Whether long term or not, I will always treat this as short term. When it is short term, at what rate will it be taxed? Slab rate. short term na, it will always be taxed at slab rate, because 111A da and the 15%. Here we are not talking about 111A, here we are talking about unlisted, in which STT is not paid. So it will become short term. So that is the concept. So transfer of unit of specified mutual fund or market linked debenture. And now one more amendment is there. From 23/7/2024 onwards, unlisted bond or unlisted debenture is also included. Unlisted bond or unlisted include debenture. So what is this specified mutual fund? See here, specified mutual fund means not more than 35% of its proceeds is invested in equity. Not more than 35 is in equity. So in equity maximum how much? 35%. Balance they can put in debt, no. So you can write in bracket debt mutual fund. Generally it is called debt mutual fund. Generally listen, 65 க்கு மேல இருந்தா ஈக்விட்டின்னு சொல்லுவாங்க. 65 க்கு மேல ஈக்விட்டி, 35 க்கு கீழ ஈக்விட்டில இருந்தா it is debt, 35 65 க்கு நடுவுல இருந்தா it is hybrid. Listen one time. If a mutual fund is investing more than 65% in equity shares, it is a equity oriented mutual fund. If it is investing less than 35% in equity shares, it is a debt mutual fund. If it is investing between 35 and 65, it is a hybrid mutual fund. Okay. So here debt mutual fund are covered. Then market linked debenture, a security where the underlying principal component is in the form of debt security and where the returns are linked to market returns or other underlying security or indexes. Okay, and then lastly this is also added, unlisted bond or unlisted debenture transferred or redeemed or matures on or after 23/7/2024. So after 23/7/2024, if any unlisted bond or unlisted debenture, unlisted bond, unlisted debenture, if that is transferred, that also will always be considered as short term. For all these three, what is the rule? Rule is that when they are transferred, it will be considered as short term. Okay, and this is overriding provision. So this will override the period of holding concept. So this only will come first. So for these three type of asset, it is always short term. Then only you see for balance asset, you see period of holding concept. Okay, so I think with this capital gain, this 55A not that important. If you don't see also, no problem. Have you finished all the concepts? I think yes. And income from other sources also, we have finished section 56 to 10. So balance is dividend concept and then other concepts.